The most dangerous lie currently circulating in the financial world is the price of an asset reflects its availability. As of this moment, on the last trading day of January 2026, that fundamental law of economics has been shattered. Silver has just collapsed from $121 to $95, a 22% destruction of value in a matter of days. By every traditional metric, this signals a surplus, a lack of interest, a market flooded with sellers. Yet, if you attempt to purchase a single ounce of physical metal right now, you will face a terrifying reality. It does not exist. The price is crashing, but the shelves are empty. This is not a market correction. This is a magic trick designed to separate you from your wealth, and the vanishing act has already begun. To understand the gravity of the situation, we must look past the red candles on the charts and observe the physical infrastructure of the global monetary system, which is currently buckling under unprecedented stress. In a functioning market, a price crash incentivizes sellers to offload inventory, making products readily available. Today, we are witnessing the exact opposite. The Perth Mint in Australia, a sovereign institution trusted by governments worldwide, has suspended wholesale orders. They are not clearing out cheap inventory. They are refusing to take new orders because they cannot source enough metal to fulfill the backlog. They have implemented rationing protocols usually reserved for wartime economies. When the entity responsible for minting a nation's currency cannot acquire the metal to do so, the spot price on a computer screen becomes irrelevant. The contagion is not isolated to Australia. The United States Mint has effectively ceased operations on its silver products. When the spot price dropped, they did not lower their prices, they suspended sales entirely. When they finally resumed, the price had not fallen to match the market. It had skyrocketed 86% overnight. This is the United States government admitting that the paper price of $91 was a fiction. They were losing money on every coin sold, so they simply stopped the game. Simultaneously, the Royal Mint in the UK is out of stock on standard bars, and Costco, a retailer synonymous with bulk abundance, has implemented strict purchase limits. When a wholesale giant has to ration bullion like it's a scarce commodity during a famine, you know the supply chain is fractured. This brings us to the mechanism behind the deception, the tale of two markets. There is the paper market, a digital casino where banks and hedge funds trade billions of dollars in derivatives, promises to deliver metal that does not exist. Then there is the physical market, where real metal must change hands. For decades, these two worlds were tethered together. Today, the rope has snapped. The paper market is screaming that silver is worth $95, while the physical market is screaming that silver cannot be bought at any price. One of these markets is lying. One is a digital hallucination. The other is the harsh reality of supply and demand. The evidence of this manipulation is visible in the flow of metal across the globe. While Western markets dump paper contracts during New York trading hours, driving the price down, Eastern markets are draining physical vaults. The Shanghai Gold Exchange just witnessed the removal of nearly 27 tons of silver in a single 24-hour period. To put that into perspective, that is nearly 1 million ounces vanishing in one day. At this drain rate, the Shanghai vaults, which are already critically low, could be completely empty in less than 3 weeks. China is not selling. They are taking delivery. They are classifying silver as a strategic national security asset, restricting exports, and hoarding every ounce while the Western paper market holds a fire sale. The disparity in behavior is stark. American institutions are selling something they do not have, creating supply out of thin air through digital keystrokes. Meanwhile, buyers in India, China, and the Middle East are backing up trucks to the warehouses. This is a transfer of wealth of historic proportions. The West is selling paper promises, and the East is collecting the real assets. This pattern has repeated for years, but the velocity has now accelerated to a breaking point. We are watching the final looting of the West's silver reserves, facilitated by a manipulated paper price that disguises the true scarcity of the metal. If you need further proof that the system is broken, look at the lease rates. The cost to borrow physical silver has exploded, with some reports showing rates as high as 39%. In a normal market, this rate is near zero. A 39% lease rate is a scream for help from the industrial complex. It means that holders of physical silver are so terrified of letting go of their metal that they demand exorbitant premiums to lend it out even for a short period. This is the technical signal that confirms the physical shortage is real, acute, and deepening. We are now in a deficit cycle that has persisted for 5 consecutive years. Since 2021, the world has consumed significantly more silver than it has mined. We have been surviving by draining above-ground stockpiles, the legacy inventory of the past century. That buffer is now gone. The bathtub has drained, and we are staring at the dry porcelain. There is no emergency reserve left to tap. When you combine 5 years of structural deficits with a sudden coordinated drain on global exchanges, you get exactly what we are seeing today: a price crash in the paper market that triggers a total freeze in the physical market. The historical parallels are ominous. In 1980, during the last great silver squeeze, a similar disconnect occurred. Dealers ran out of stock, premiums exploded, and the paper price eventually had no choice but to rocket upward to meet reality. Physics dictates that you cannot suppress the price of a finite resource forever when demand exceeds supply. You can print paper contracts to infinity, but you cannot print silver. Eventually, the paper market, with its infinite supply of promises, will collide with the physical market, which has hit a brick wall of scarcity. We are approaching the moment where the paper price becomes meaningless because no metal changes hands at that level. So what happens when the music stops? The market bifurcates. The paper price may continue to be volatile, manipulated by entities desperate to maintain the illusion of stability. But the real price, the price you pay to actually hold the metal, will detach completely. We are already seeing this with premiums in Japan hitting 60% and Dubai hitting 40%. The spot price is becoming nothing more than a reference number for a game that no longer allows physical delivery. If you hold paper silver, you own a claim on a bankrupt counterparty. If you hold physical silver, you own the asset that the entire industrial and monetary world is scrambling to secure. Do not be the victim of the red candles on the chart. The crash is designed to induce panic, to shake the metal loose from weak hands so it can be vacuumed up by strong hands in Shanghai and Mumbai. The scarcity is real. The mints are closed not because they want to be, but because they have to be. The vaults are emptying. The lease rates are flashing red. Everything you have been told about the value of silver this week is a fabrication derived from a broken derivative market. The real story is simple. They dumped the paper, but they took the metal. And now, there is nothing left for anyone else